Welcome back to Deloitte's webcast, Accounting and Assurance Update for Private Enterprises. In this segment, we're going to explore the active ASPE projects of the Canadian Accounting Standards Board. We expect that many of you will be keenly interested in the two exposure drafts that are proposed for years beginning on or after January 1st, 2020, which address the current exemption for preferred shares issued in certain tax planning arrangements and a revised measurement model for related party financial instruments. I'm now joined by Deanna DeCitas, who will walk us through these areas in more detail. Deanna?
Thanks, John, and welcome everyone. So now we'll have a look at what's happening up at the Accounting Standards Board level. The Accounting Standards Board has recently announced that they will not undertake a 2018 annual improvements project, instead choosing to focus its effort on its active projects that are listed on the slide. The first of these is their agricultural project. This project is intended to address the diversity in practice that exists today due to the limited guidance in the handbook on the accounting for agricultural activity, in particular the accounting for living plants and animals. In 2017, the Accounting Standards Board formed an agriculture advisory group and continues to work through issues raised in response to its 2015 discussion paper, as well as outreach conducted since then on this topic. If you have agricultural activities, you'll want to watch out for the exposure draft, which is expected to be issued in the third quarter of 2018. In the meantime, you can keep abreast of developments on the agriculture project by going to the FRAS Canada website on the link indicated on the slide. So moving to consultation on priorities for Part 2, this continues as the Accounting Standards Board considers which topics should be prioritized for further research. The Board has determined that 3 additional topics should be prioritized for further research in addition to its research activities on Section 3400, the Accounting Standard for Revenue. The Board has directed staff to seek input from its Private Enterprise Advisory Committee on these topics before it makes a final decision. So now let's have a look at 2 recently issued exposure drafts that are listed on the slide. So as many of you are probably aware, there's currently an exemption in ASPE that allows a company which has issued preferred shares in a tax planning arrangement under one of several specific sections of the Income Tax Act to classify those shares as equity, even though the shares are redeemable at the option of the holder and would otherwise meet the definition of a liability. Under this exemption, the shares are measured at their par, stated, or assigned value, which is usually nominal. These shares would be classified from equity to liabilities when their redemption is demanded, and at that point the shares would be measured at their redemption amount. And this exemption is found in paragraph 23 of section 3856. So why doesn't the current exemption work? The Board's original intention was that the exemption be applied to estate freeze transactions that transfer a business from one generation to the next. Through the Board's research, though, they came to understand that paragraph 3856(23) was being applied to transactions beyond those originally intended, such as to commercial financing arrangements, transfers of individual assets, and management buyouts. Also, there are some redeemable preferred shares that were issued in a tax planning arrangement that did not qualify because the arrangement was not executed under any of the specified Income Tax Act sections, even though the transactions were similar to those for which the exemption was originally intended. Lastly, there's some confusion as to when redeemable preferred shares should be reclassified from equity to liabilities due to the broad range of redemption features associated with these types of arrangements. So as a result, the the board has decided not to eliminate the exemption entirely, but to propose a new model for evaluating whether shares issued in a tax planning arrangement would qualify for equity treatment. The shares that are within the scope of the new model are retractable or mandatorily redeemable shares issued in a tax planning arrangement. Those shares generally have the following attributes. The holder has the right to require redemption on demand at a redemption price that's equal to the fair market value of the common shares exchanged. The shares also have at least voting rights on any matter involving a modification as to the attributes attached to those shares. There's also no restrictions on their transfer, and the shares have priority over distribution and liquidation over any other class of shares. And lastly, the shares are issued as part of a tax planning arrangement. Now, the exposure draft uses the term tax planning arrangements to refer to those arrangements within the scope of the exemption, but does not define the term. So the intention is that stakeholders will exercise professional judgment when determining what constitutes a tax planning arrangement. So let's get into the meat of the proposed model. So under the proposed model, retractable or mandatorily redeemable shares issued in a tax planning arrangement are classified as equity only when the following three conditions are met. So the first condition is that there's no change in control of the enterprise, meaning that control of the enterprise that's issuing the retractable or mandatorily redeemable shares is retained by the shareholder receiving those shares. So the thought here is really that if the transaction leads to a change in control of the enterprise, something of substance has changed, and liability classification would be required. Now, control is defined in Section 5091, the standard for subsidiaries that Glenda just touched on, as the continuing power to direct the strategic operating, investing, and financing policies of an enterprise without the cooperation of others. Now, in order to facilitate the application of this, the exposure draft is proposing to add new guidance on substantive rights to assist enterprises in this assessment of control. Now, several stakeholders have raised the issue as to whether two related parties could be considered a single unit of account for assessing control. But the board has decided not to provide guidance on this as it could have broader implications for other related party transactions. The second condition is that no consideration other than shares are exchanged in the transaction, meaning that the only consideration exchanged is one class of shares for another class of shares in the enterprise issuing the shares. As a result of this, asset rollover transactions will not meet this condition. In these transactions, an asset or group of assets are being transferred to an enterprise in exchange for redeemable shares. So in these cases, the shareholder is not freezing the value of the business, but transferring assets into the enterprise on a tax-deferred basis. Because those assets will change the cash flows of the enterprise, it violates the premise that nothing of substance has changed, and therefore the shares issued in those asset rollover transactions would not qualify for equity classification. Now, the last condition is that there's no redemption schedule. So this means that there's no implicit or explicit arrangement that exists that would require redemption of the retractable or mandatorily redeemable shares in a fixed or determinable period. Therefore, the existence of a redemption schedule specifying the timing of the redemption of the shares by the issuer would violate this condition and require liability classification of those shares. So from an accounting perspective, what does this mean? If the shares meet all three conditions, that I just reviewed, they would be classified as equity and measured at their par, stated, or signed value. The exposure draft proposes that these shares that are classified as equity are not reclassified unless an event or a transaction subsequently occurs after initial recognition that might indicate that the conditions for equity classification are no longer met. The types of conditions that would trigger a review of the classification of the shares would include things like death of the shareholder holding the mandatorily redeemable or retractable shares, a change in the ownership of the enterprise which issued the shares, or redemption of some or all of the mandatorily redeemable shares. In those situations where it's determined that one or more of the conditions for equity classification are no longer met, such shares would need to be reclassified as liabilities. So let's look at what happens if the shares do not meet all three of the conditions when issued. Those shares would be classified as a financial liability and measured at their redemption amount, which is the amount due on demand. Now, the offset to the liability classification would be to record an offsetting charge to a separate component of equity. Because the shares are redeemable on demand, usually to meet tax requirements, they would also be classified as current liabilities. So under the proposal, if the retractable or mandatorily redeemable shares are classified as a liability, they would be prohibited from being reclassified to equity even if conditions change. So as a result of the proposed model, we ask ourselves, in what types of tax planning arrangements are mandatorily redeemable or retractable shares expected to qualify for equity classification? The exposure draft indicates that retractable or mandatorily redeemable shares issued in estate freeze transactions in which all three conditions are met would qualify for equity classification. However, other tax planning arrangements which fail one or more of the conditions would not qualify. And as mentioned earlier, asset rollover transactions will also not qualify for equity treatment under the proposals. So let's have a look at an example of how the proposed model might apply in practice. So in this situation, we have two unrelated shareholders, X and Y, and initially shareholder X owns 10 common shares which carry 10% of the voting rights in Company A, and shareholder Y owns the remaining 90 common shares carrying 90% of the voting rights. Assuming there are no contractual arrangements in place that impact on control, shareholder Y controls Company A through its 90% voting interest. Shareholder Y then executes an estate freeze transaction whereby he exchanges his 90% common shares for retractable or mandatorily redeemable shares with a value equal to 90% of the equity of Company A. And those shares carry 90% of the voting rights. Therefore, he's freezing his value in the business. So looking back at the three conditions in the proposed model, in this case, shareholder Y retains control of the business as he controls the enterprise both before and after the transaction. The only consideration that's exchanged in this transaction is one class of shares for another, so that condition is met as well. And the facts don't indicate that the shares have a redemption schedule. So as a result, all three conditions are met and the retractable or mandatorily redeemable shares would meet the conditions for equity classification by Company A. Let's have a look at a second example. So in this example, we have two shareholders, X and Y, which are unrelated parties, which each own 50% of the common shares of Company A. Now, the common shares represent equal voting interests, meaning each of the shareholders have 50% of the voting rights. However, under a shareholders agreement, all decisions on the strategic operating, investing, and financing policies of Company A require the consensus of all shareholders. So then we turn to the right of the slide, and shareholders X and Y undertake an estate freeze of Company A. In this case, each shareholder will exchange, as part of the estate freeze, their 50% of the common shares for 33% of the common shares of the company, plus mandatorily redeemable shares, which are non-voting and redeemable at 50% of the value of the business on the date of the transaction. In addition, a new shareholder is added, shareholder Z, which subscribes for 33% of the common shares, which carry a corresponding number of the votes. So let's have a look at the three conditions for equity classification in this example. The first condition, as to whether control exists before and after the transaction, is not met, in that no individual controlled the company on his or her own before and after the transaction. Instead, each shareholder had joint control over the enterprise before and after the transaction. Therefore, that first condition is not met. As a result, the mandatorily redeemable shares issued would be required to be classified as financial liabilities by Company A due to the joint control. So next we'll look at the effective date and transition for the exposure draft. The exposure draft proposes that the amendments are effective for fiscal years beginning on or after Jan 1, 2020 and are applicable retrospectively. Under the proposals, the company would assess whether the conditions for equity classification are met on the date that the amendments are applied for the first time, so not on the original date of the transaction. So in other words, the conditions for equity classification are assessed as though the tax planning arrangement occurred on the date the enterprise applies the amendments for the first time. Now, there is transitional relief available in that a company is not required to assess shares that are redeemed before the effective date. And in addition, the company has the option not to restate its comparatives. So if it elects to apply the amendments on January 1st, 2020, and it's a calendar year-end entity, any adjustment due to the reclassification of its retractable or mandatorily redeemable shares is recorded in opening equity of that current year. So the following is a high-level example of what might occur on transition if redeemable preferred shares issued in a tax planning arrangement fail to meet the conditions for equity classification. In this example, we have a shareholder that transferred land to its wholly owned company in exchange for redeemable preferred shares in the company. The par amount of those shares is 100 and the redemption amount is 1,000. And this transaction occurred in 2012. At that point, the redeemable preferred shares were originally classified as equity under Section 3856, paragraph 23. However, under the exposure draft, because the transaction does not involve the exchange of one class of shares for another, and new assets are introduced into the entity, the shares would have to be reclassified as liabilities. The accounting for the land would not be impacted, as it would still be recorded at its carrying amount by the company. So this slide illustrates that under the exposure draft proposals, the tax planning shares would be reclassified from equity in the amount of $100 to liabilities and remeasured at their redemption amount of 1,000. The shares would also be classified as current liabilities, as they're redeemable at any time at the option of the holder. And the difference between the redemption amount of the shares being the 1,000 and their former carrying amount of 100 would be recorded as a separate component of equity at $900. So this alleviates some of the burden associated with reclassifying those shares and putting that debit to retained earnings. It would instead, under the proposals, go to the separate component of equity. Also, if the company applies the future income taxes method, the change in the carrying value of those shares is likely to have future income tax consequences, which have been ignored here for simplicity. As you can imagine, this reclassification could adversely impact a company's key performance measures, such as its current ratio, because as the current liabilities increase, the current ratio would fall. And it would also impact its debt-to-equity ratio, because as the liabilities increase, the debt-to-equity ratio would also rise. If bank covenants are based on these metrics, they may need to be renegotiated. So let's have a look at some key considerations that you might have coming out of this exposure draft. Do you have any outstanding retractable or mandatorily redeemable shares issued in a tax planning arrangement that are impacted by the proposals in the exposure draft? If so, would they meet the 3 conditions for equity classification? And if not, how would your financial statements be impacted, including taking into account the impact on key performance measures and any bank covenants? Just as a reminder, the comments on the exposure draft are due back to the Accounting Standards Board by January 15th, 2018. So if you think you'll be impacted, you're encouraged to submit your response and have your voice heard, whether that's that you're in agreement with the proposals or you're not in agreement with the proposals. So with that, we'll shift gears a little bit and look at a second recently issued exposure draft on the accounting for related party financial instruments and significant risk disclosures. You may remember that the financial instrument standard was significantly rewritten in moving from Part 5 to ASPE. So in 2014, the Accounting Standards Board undertook to perform a post-implementation review on Section 3856, the Accounting Standard for Financial Instruments, to assess the effectiveness of that guidance. The post-implementation review identified several issues, including a lack of clarity on the measurement of financial instruments issued between related parties. So for example, the standard is not clear on how to measure a newly issued financial instrument in a related party transaction, and whether financial instruments should be measured under Section 3856 or the related party standard, Section 3840, after initial recognition. There are certain other areas identified in the post-implementation review, such as the accounting for hedging and fair value, that will remain as topics potentially for future projects, depending on the Accounting Standards Board's relative priorities for Part 2 projects. So under the exposure draft, it proposes a simplified measurement model for measuring related party financial instruments. Essentially, equity instruments that are quoted in an active market and derivative contracts would be measured at fair market value, with any subsequent changes going through P&L. Now this excludes derivatives and certain qualifying hedging relationships. All other related party financial instruments would be initially measured at cost, and those measured at cost would subsequently be reduced for any impairment losses in their value. So this flow chart shows how the cost of a related party financial instrument would be determined under the proposals. The cost of a financial asset originated or acquired, or a financial liability issued or assumed, would depend on whether the financial instrument has repayment terms. So going down the left-hand side of the chart, when the financial instrument has repayment terms, the cost is determined using the undiscounted cash flows of that instrument excluding interest and dividend payments. When the financial instrument does not have repayment terms, the cost of the instrument is determined by the consideration transferred by the enterprise. So when the consideration transferred is a financial instrument with repayment terms, the cost of the instrument is determined using the undiscounted cash flows of the financial instrument that has been transferred as consideration. And when that consideration transferred does not have repayment terms, the cost is determined by looking at several criteria. Is the transaction a monetary transaction or a non-monetary transaction that has commercial substance, with a change in ownership interest of the item transferred, and the consideration is supported by independent evidence? Now, you might recognize these criteria from section 3840. If all three of these criteria are met, the cost of the financial instrument is measured at the exchange amount of the consideration transferred. But if one or more of these criteria is not met, the financial instrument is measured at its carrying amount of the consideration transferred. So let's look at how the proposed guidance would work. In this example, we have a parent company which advances $100,000 in cash to its subsidiary and receives as consideration a note receivable. The note has a face amount of $100,000. It has no maturity date and no specified terms of repayment. So the question is how the note receivable and note payable should be measured. The parent and its subsidiary are by definition related parties, since the parent controls the subsidiary. So the first question is whether the financial instrument in the related party transaction has repayment terms. And although the facts would suggest that it does not have repayment terms, it does, because a debt instrument with no stated repayment terms is deemed to be payable on demand under section 3856, paragraph 812. Therefore, the note receivable is measured at the undiscounted cash flows of the note, which is $100,000, and the note payable would follow the same logic and is also measured at the undiscounted cash flows of the note of $100,000. So we'll look at a second example in which a parent transfers land to its wholly owned subsidiary and receives as consideration common shares in the subsidiary. The carrying amount of the land on the books of the parent is $90,000. So the question is how to measure the common shares received by the parent. The transaction is again one between related parties, since it's between a parent and its subsidiary. So the first question is, does the financial asset have repayment terms? And the answer is no, because they're common shares. So the next consideration is whether the consideration transferred by the parent is a financial instrument with repayment terms. And it's not in this case, since it's land. So the next thing to consider in the proposed model is whether the transaction is a monetary transaction or non-monetary transaction with commercial substance, whether there's a substantive change in the ownership of the item transferred, being the land, and whether the consideration is supported by independent evidence. In this case, the transaction fails the second criterion because there's no substantive change in the ownership of the land. The land is really passing from a parent to its wholly owned subsidiary. So the cost of the common shares is the carrying amount of the consideration transferred, which is the carrying amount of the land to its parent. So this next slide shows the journal entries. So the parent records the investment in the subsidiary at $90,000 and derecognizes the land at its carrying amount. Based on the examples in the exposure draft, the subsidiary would follow the mirror accounting, in that it records the land at $90,000, being the carrying amount to the parent, and records an offsetting credit for the common shares issued in the same amount, being $90,000. So one important thing to note is that the proposals in the exposure draft do not impact how non-financial instrument consideration is measured. So in this case, the land would be measured at its carrying amount to the seller. So there are a number of other key highlights to the exposure draft that we just wanted to point out. The first is that the exposure draft clarifies that enterprises with related party compound instruments are permitted to initially measure the equity component of those instruments at zero. And this treatment is consistent with the same accounting that would be followed if a compound financial instrument that has both liability and equity components would be issued in an arm's length transaction. So this really fills a void in the standard in terms of how to address related party compound instruments. The other clarification that's been made is how to assess related party financial assets from the perspective of impairment and forgiveness. So the proposal clarifies that this is really a two-step approach, where an impairment assessment is first completed on the related party financial asset to determine whether it's impaired, and any impairment loss would be recognized in net income. And then any remaining forgiveness of that related party asset would then be recorded in equity or net income depending on how the related party balance originated. And the reason for this clarification is that there had been some questions arising in practice as to when you had an impairment of a financial asset such as a loan and a forgiveness as to whether both the impairment and forgiveness would be accounted for both in net income or both in equity. And this provides some more guidance in terms of the assessment of those transactions and more direction on that accounting. So flipping to the other side of the balance sheet, there's also new guidance on related party financial liabilities to simplify the treatment of modifications. The streamlined method proposed in the exposure draft would require that all modifications of related party financial liabilities are treated as an extinguishment. So this guidance is intended to relieve enterprises from having to apply the rules for arm's length transactions, which involves an analysis of the present value of those future cash flows, otherwise known as the 10% test. Finally, there's a proposal relating to the disclosure requirements of derivatives. So previously, significant risks arising from derivatives were required to be disclosed separately, where the exposure draft proposes that such disclosure would be included with the risks arising from other financial instruments. Now, the proposals in this exposure draft relating to related party financial instruments and significant risk disclosures are effective for fiscal years beginning on or after Jan 1, 2020 and are applicable retrospectively with simplified transitional provisions. So there are a couple of key considerations to think about. Do you enter into significant related party transactions? And if so, does the consideration exchange include financial instruments with repayment terms, such as notes or loans, or without repayment terms, such as shares or warrants? Lastly, will these amendments simplify the measurement of related party financial instruments in your organization, given the limited circumstances in the exposure draft when fair value measurements would be required? So as you think about those, just to keep in mind that comments on the exposure draft are due back to the Accounting Standards Board by January 29, 2018. So if you will be impacted, you're certainly encouraged to have your voice heard as to whether you agree or disagree with the proposals. And with that, I will turn it back to John.
Thank you very much, Deanna. The retractable shares issue has been a hot potato for some time, and the related party financial instruments measurement issue dates back to the dawn of our current related party transaction model. In our next video, we move to the assurance portion of our webcast and discuss various developments impacting your financial statements, varying from bookkeeping to audit engagements.